people are hurting right now. In fact, there was just a survey that came out. I saw it up initially on a Zero Hedge tweet that more than 50% of the public now are saying that higher prices are really harming their standard of living, right? So Paul Krugman is talking about how we've won the inflation war, but the public is suffering because they are losing this war. In fact, the consumer sentiment numbers came out today, and it was much weaker than expected. The number came out at 63, and that was a huge drop from the 68.1 in the prior month, and way lower than the expectation, which was 67.5. And the reason for the big drop was the huge increase in inflation expectations, which were at 3.2% last month. They now jumped up to 3.8%. That's the highest in 5 months. So the Fed is claiming victory. Krugman is cheerleading victory. Hey, we've got inflation, but here, expectations are rising. And especially when the Fed places so much, a weighting on expectations, right? Because the Fed thinks that prices go up because consumers expect it, and that is a self-fulfilling prophecy. That's BS. It's got nothing to do with expectations. But considering that they think expectations play a big role, this should be a big deal, that the consumers are now expecting 3.8 when the Fed is targeting 2.0, and the numbers are going in the wrong direction. So that's one of the reasons that you got consumers so upset.
Peter Schiff delves into the alarming impact of rising inflation on the public's standard of living. He discusses recent survey data indicating that over 50% of the population feels the pinch of higher prices, contradicting claims of an inflation victory by economists like Paul Krugman. Consumer sentiment plummeted to 63, well below the anticipated 67.5, primarily due to a significant spike in inflation expectations, now at 3.8%. Schiff criticizes the Federal Reserve's focus on expectations, arguing that this approach doesn't reflect the reality of price hikes. Schiff highlights key economic indicators, focusing on the Producer Price Index, which exceeded expectations with a 0.5% increase. Year over year, producer prices rose by 2.2%, surpassing the 2% target set by the Fed. He emphasizes that these numbers, particularly the inflation rates, point to a troubling trend, significantly impacting essential goods and services. Despite the worrisome data, Schiff observes a surprising resilience in the gold market, even in the face of hot CPI numbers. He suggests that gold may have hit its lows, having tested support levels below 1900 and rebounded strongly. The big question, according to Schiff, is whether gold will break through its resistance or face further challenges.
Because everything they need to buy is so much more expensive. But anyway, let's get into these official numbers that we got. First, the PPI, the Producer Price Index, that came out on Wednesday. So the expectation was for a rise of 0.3, and the actual increase was 0.5. So substantially above the estimate, not as high as the prior month, but the prior month was up 0.7. That was a big deal. Now you got 0.7 one month, 0.5 another month. These are big numbers back to back. The year-over-year increase now, which was 1.6% last month, below 2%, that prior month was revised up to 2% from the original 1.6. The expectation for this month was up 1.7, and it came out at up 2.2. So now we're back above 2%, headed higher. Ex food and energy, month over month, that was in line at up 0.3, but that's still, you annualize 0.3, that's still above 2% if you take 0.3 12 times. But the year over year, ex food and energy, the actual year over year is 2.7, well above 2%. And again, this is the producer prices, not the consumer prices. So this number came out hotter than expected. Again, gold shrugged that off. We didn't have a big sell-off in gold like we might have in the past off of a hot CPI. Again, reinforcing the fact that gold has seen its lows. We've tested support below 1900. It was a big test. It got way below 1900. It never got below 1800, and the buying came in with a vengeance. And again, now we're 1930 and change. I think we're now headed back up to test the other side. and we'll see if that resistance continues to hold or if it fails. I mean, my money is that it's going to fail. The question is when. Will this be the time, or is it going to have to bang against that wall a few more times?
In this next segment, Peter Schiff provides a stark assessment of the current economic landscape, emphasizing the growing challenges of rising inflation. He discusses recent market fluctuations, sharing his personal strategy of seizing opportunities during stock dips. Schiff advocates a patient approach, urging viewers not to succumb to market panic, but to capitalize on others' mistakes, transforming them into potential rewards. Schiff critically examines the latest Consumer Price Index, CPI data, revealing a concerning trend. Despite the Federal Reserve's efforts, inflation remains high, with the CPI up by 3.7% year over year. He questions the Fed's ability to combat this inflation surge, especially considering their limited options after multiple rate hikes. The analysis underscores the gravity of the situation. Inflation is not showing signs of abating, and the Fed's traditional tools might be insufficient to address the issue. Schiff's insights shed light on the challenges ahead, leaving viewers with a crucial question. How will the markets respond to the ongoing inflationary pressures, and what could this mean for their investments?
We'll see. But I added, personally, I bought more gold stocks on this dip. I mentioned that on the podcast that I was in there buying with my own money on that dip. And I did. And so now I'm kind of sitting back and see what happens. But I'm glad I got that opportunity. Don't get mad, get even. If the markets are dumb enough to sell off these stocks and the price goes down, don't get upset because your account is down. It's an opportunity for you to buy more. The prices are immaterial if you don't sell. Yeah, now if you're fooled, if you get shaken out, if you get scared, if you think, oh my God, I better get out because the price went down and it might go lower, yeah, then it means something. If you're dumb enough to sell into that market, yeah, you take a loss. But if you're smart enough to take the other side of that trade, you turn somebody else's mistake into your reward. They panic and you take advantage of the situation. Because you know what's going to happen? When we get back up to the highs, there are going to be some people that want to buy. Oh my God, it's really moving up. I better get in. Right? That's what I step back. If anything, you could sell a little bit up there if you wanted to, if you're trading. But I like to buy low. I mean, call me crazy, but I like to pay lower prices, right? So when the prices go up, I kind of sit back and I wait and see what happens. And if I get another opportunity to buy cheap again, I'll do it. I keep building my portfolio because I earn money. I got to do something with it. I don't spend it all. And if that's the case with most people, you get an opportunity, you earn some money, you got to put it someplace. And if the things that you like are cheaper in price, well, it's a great time to deploy that money. But I said I have cash on the sidelines because the markets are weak. I saw another one of the stocks I liked today that went down. It was 52-week low. I bought some of it. That's what you do. You have dry powder and you get, opportunities and you take advantage of them. But anyway, so the CPI, which came out yesterday, again, hotter than expectations. The consensus was for a 0.3% increase in prices for September. And we were up 0.4. And 0.4 is not a low number. I mean, if you're targeting 2% inflation, you can't have 0.4. Because if you have 0.4 for 12 months, you're way more than 2%. And prior month was up 0.6. So if you average 0.6 and 0.4, the last 2 months, it averages 0.5%, 0.5. That's a big number. Nowhere close to annualizing 2%. The year-over-year CPI up 3.7%. That matches the 3.7% from the prior month, but now you got 2 months back-to-back of 3.7 in an upward trend. How is that making progress to 2%? You're not making any progress. Ex-food and energy, this so-called core, was up 0.3% on the month. It was up 0.3% last month. That's not getting any better. And again, if you have 3.3% every month, you're nowhere near 2%. In fact, the year-over-year core was up 4.1. Yes, a little bit less than the 4.3 from the prior month, but back-to-back months above 4, that's double the so-called target. The Fed is nowhere near achieving this goal. You've got all these people, celebrating this premature victory. Look, the Fed is pretty much out of ammo. We got more confirmation from FOMC members that were talking this week that the Fed is basically done with rate hikes. I mean, maybe there's one more 25 basis point hike coming, but maybe not at all. A lot of people now think that that's it. Well, if the Fed is done hiking rates, how's it going to stop inflation from getting worse? It's already moved rates from 0 to 5, 5.25, 5.5, and the inflation problem hasn't gone away. We're still way above 2% despite all those rate hikes. And what's the Fed going to do if after we kind of bottom out at this 3-4% level, we start going back up to 9%? What are they going to do? Are they going to raise another 500 basis points? Are they going to bring rates up to 10%? I don't think so, but that's what the market would require. But they're not going to do that. They're pretty much out of ammo.
Thank you for tuning in to this eye-opening analysis. We hope you found this discussion insightful and thought-provoking. Remember, understanding the complexities of the financial landscape is crucial in making informed decisions about your investments. If you appreciated the insights shared in this video, don't forget to hit the like button, subscribe to our channel, and click on the notification bell so you never miss an update. Share your thoughts and questions in the comments below. We love hearing from our viewers. Stay informed, stay vigilant, and most importantly, stay ahead in your financial journey. Until next time, take care and invest wisely.